Traders are continuing to tweak their expectations for U.S. interest rates as the Federal Reserve meets, and have now begun to anticipate the central bank's policy rate peaking in September rather than July. And the latest calculations extend Tuesday's more dramatic reassessment, sparked by May inflation readings that were more benign than expected. Those led to a drop in wagers on a hike for store at the meeting that concludes at 2 p.m. in Washington, as well as a pairing of bets that the Fed will lower rates at any point this year. The Fed's target range for the federal funds rate, which it has seen leaving unchanged at 5 to 25%, has resulted in an actual rate of 5.08%. The highest rate on swap contracts for future meetings was about 5.27% in September on Wednesday, with the one for July at 5.26%. As recently as Tuesday, July's rate was higher, and while both contracts priced more than 70% odds of a quarter-point increase, a higher rate for September suggests traders see a small chance of it being delayed until that month. Upcoming Fed meetings are scheduled for July 26th and September 20th. The minority view that the Fed might raise rates in June got beaten up Tuesday by May inflation data that showed more deceleration than expected. However, the view that the rate cuts are possible during the second half of the year was also damaged, as inflation remains well above the Fed's 2% target. The December contract rate at 5.1B and the summer C-out is a conflict percent club, the descender into the listed endpoint mocks. The Gravitors as a 19 model is again named the prospect of a hawkish policy outlook from Fed officials via their latest summary of economic projections, to be released Wednesday with the rate decision, has driven short-term Treasury note yields to their highest levels since March. It seems likely and will be articulated in the set. The Fed has more work to do, said Gregory Farinello, head of U.S. rates trading and strategy for Amerilet Securities. But a pause in June doesn't necessarily mean a hike in July. If economic trends are sustained, he said, front-end Treasury yields dipped in U.S. trading Wednesday following the release of additional inflation data for wholesale prices, which also slowed more than economists had estimated. The two-year retreated to around 4.61% from Tuesday's high of 4.777%, the 5-year to 3.95%. UK government bond yields also declined after some soared to multi-year highs on Tuesday, and strong labor market data drove up expectations for Bank of England rate increases.